Humans react to incentives. Like, clearly these guys are getting something out of this conversation. There's a carrot, there's a stick, there's a reason there's talking while I'm talking. The financial system is no different. In a non-interest rate environment, the banking system resorts to fees, but that is obviously not a long-term solution. So, what is? What are the differentiators that will continue to fortify us against an increasingly competitive market? I know that's a lot of buzzwords, but you know the question that I'm asking. The banking reinvention expert himself, the man, Alessandro Hatami, will guide us through the forest of competition and differentiation alongside ING, Temenos, and Starling Bank. Let's welcome him to the stage.
We're having an interesting panel today because we have a challenger bank and an incumbent bank. Now look at their clothes. See which one is which, guys. Is it the guy with the leather shoes and the trainers, or is it the guy who's the incumbent bank?
I was a consultant in a former life.
So jokingly, we were saying they both pretended to be each other, but that's the funny joke here. So first question for you guys. What makes a successful bank? What is the right way to differentiate? Let's start with you, Jeroen.
Well, there's many answers.
Give me a cool one.
Give me a cool one. Specifically now, I think it's a combination of customer experience and the focus on sustainability. And when we talk about sustainability, there's many areas. There's E and S and G. And I would specifically like to highlight the S, social, on financial health. And specifically where we find ourselves now, current situation, the war in the Ukraine, gas prices going up, there's going to be a lot of our consumers that are going to be in financial trouble. So it's a combination of customer experience. Banking products have been commoditized, are being commoditized. So if you really want to continue to make a difference, it needs to be personal, it needs to be instant, relevant, and seamless, connected with the sustainability focus, i.e. financial health. That's how we believe we can continue to make a difference.
So, do you agree on that, Sam? Would you give something more, something a little bit more?
Yeah, from the challenger, so I should probably have a cool answer, but I think we were a naturally cool organization. I mean, my background at Starling is running product and product design for the last few years, so I should absolutely say personalization and experience is the difference. But actually, I think the real difference for the banking providers coming through is genuinely establishing trust. Because banks make money by holding money and lending money and on the transactions when they move money, and people aren't going to deposit their savings with you, their hard-earned money, or spend every day with you unless they really trust you. And that trust is very hard to establish, and you need it on a number of different levels, from an onboarding experience that feels like what they expect, from an equivalent to going into the bank branch. Actually, you need a level of friction in it so that they think you're a real organization, you're fulfilling your obligations, you're doing what you need to keep their money secure. Through to in-life experiences, both friction in journeys to protect them from fraud and also to protect them from themselves. An increasing amount of fraud goes through that way and is genuinely authorized. And then you've got the bigger picture for the newer banking providers coming through. I guess actually, can you trust the organization is going to be around in 5, 10, 20 years? So many of the ones in the sector at the moment are loss-making, and we've already seen some disappear in the UK. But at the same time, is that company going to is it going to continue to innovate and stay ahead so that you don't have to switch providers? Money's a very emotive topic, and people don't like talking about it. They don't like dealing with it or managing it, and so you want something that you feel you can trust and will do the right thing by you going forward. I think that's often overlooked in this world where we're talking constantly about technology and performance and customer experience.
So you both agree on customer experience. You, Sam, you're adding also trust, but I assume that's built into.
That is,
you take it for granted.
You can take that for granted.
Well, that's sine qua non, although it has become even more important, Alessandro, because, starting the pandemic, everything became digital, not because we wanted to, but also because, the bank branch was not available. So we saw that everybody went mobile, and it worked out. And quite amazingly and impressive to see how easy it was for people to go home. It's difficult to bring them back in. That's a bigger challenge. But what we saw was that obviously we need to be on 24/7 on the mobile, and that has become a bigger threat. Plus, there's mobile not for everybody. As I was mentioning to you backstage, a lot of our customers would love to go mobile and 100% mobile, but there's other people in Dutch society. We serve 7.5 million customers in the country, including the elderly or people that are less comfortable with mobile. So they still would like to have human interaction instead of chatbots and only interaction via the mobile.
So it's interesting. So you're talking about mobile. Obviously, mobile is one of the channels. But I would argue that possibly the incumbent banks or even the fintechs are not the greatest experiences on mobile devices, social platforms and other players are that. So, and we're seeing a lot of interest in some of these non-banking players to actually become digital. So if we were to look from today to the future, you are creating a differentiated proposition. Isn't the most differentiated proposition in financial services one that is created by a big social platform or somebody else that is not a bank? And how you're going to be able to, is that a good thing or a bad thing? Will you like it? Will you hate it?
Well,
let's say ask Sam this time because
I don't think they even need to differentiate. Those platforms have got huge market position and they've used that to great effect in a number of areas to grow market share, so replicating and following could work well enough for them. The question is whether that is a threat to banks or not. And I don't think it is, because being a regulated bank and the burdens that come with you is huge, and it really changes the way your organization works. And so none of the tech firms have looked like they're likely to move into becoming regulated entities, and doing that all over the world is hugely costly. And so the banks will still need to exist underneath, but they might not control the customer experience to the same extent, and that's a threat unless you have a very low cost base and a platform that can cope with that kind of.
So let me challenge you on that. A few years ago, I think Ann Bowden, the CEO of Starling, said that the biggest differentiator between Starling and an incumbent bank is that you offer the same things at 30% less cost.
Yep.
Which I thought was a great proposition. If you go through a channel to deliver your proposition, therefore, if you start offering banking through a Facebook of this world, you don't have to have branches. Therefore, the costs that the ING guys have of branches, maintaining people, et cetera, are gone. So you're competing on equal footing. So they become a lot more formidable challengers to you than they would be if you had to go direct. Isn't that a risk that you run?
No, because there's still a cost of the technology and the cost of the operations teams and the servicing behind it. And our technology cost is a fraction of what it is at some of the big banks, and should continue to do so. And I think reducing your cost to that extent in a legacy bank is.
So, Jeroen, do you agree? You are overpriced on everything you do.
Oh, we're not overpriced. We charge fairly, but we offer a great service first, because otherwise people leave and don't come to us in the first place. On the initial question on fintech, big tech, yes, it's a threat, but it's an opportunity at the same time. So we actually married a big tech, a fintech, and a bank in Germany. So there was a fintech that we acquired, Lendico, and together with our business banking colleagues, we have now created a triage with Amazon, because there's a lot of retailers that want to sell their stuff on Amazon. They need funding, we provide the funding, and via our Lendico engine, we work together. And to your point, Amazon is not interested, in my view, to become a fully regulated bank, so there's ample opportunity for us to make a difference there. So that's where we work together. Mm-hmm. Now, we've built 2 platforms ourselves. Dealwise originates from our Romania franchise, where we put merchants and consumers together as well. We looked at the pain points. Consumers don't get the right offers, and the merchants, they lack the final business execution. So we put those together. We're now rolling that out in Belgium and in Germany. And then we have the puntenwinkel here in the Netherlands that used to be called the rentepunt, the interest, but we no longer pay interest, so now it's called the point store, where we reach 7.5 million people. So we've built our own platforms internally as well.
So thank you for that good analysis of all of everything you've done. That sounds like a nightmare, actually.
Why is that?
And these guys that have a single platform that can serve whatever market they go after seems to be a lot more efficient. Or am I misreading what you just said to me?
Well, we've learned via, over the past 6-7 years while going through the transformation, that becoming one bank, which is the same front to end in every country, is very difficult to achieve. Because we talk about Europe, and a house is a house in Germany, Netherlands, France, and Turkey, but mortgages are very different.
Oh, passporting doesn't work, you're saying?
No. To a certain extent, from a back-end perspective, there is a lot you can do, but at a certain point in time, the last mile, there you have a lot of local differences, local regulatory, local customer requirements. There's intermediaries that you have in Italy and in Belgium, but not in France. So you cannot do 100% the same in every country, back to end.
So we talked about the platformization of the front. If you think of it, when you talk about working with becoming a provider of banking services to a platform, you're actually using a platform that is a third party in the front of the business. What about the back end of the business? We're talking about banking as a service, where you can actually complement your existing propositions with a third party. Sam, Starling has always said that they think that that's an interesting business model to engage in. What are your thoughts? Is that in the long term, that is something that will be a viable model, or is it something that is just a temporary thought?
Yeah, it's something we've been operating for 3 or 4 years now. We've got 25 or so customers that are using components or a large proportion of our system. So everything from people processing payments and accessing payment schemes through to white-labeled kind of API-based accounts. So they bring their own digital channels and proposition experience and are using us as the banking infrastructure, the license holder, and the ability to hold deposits. So you can make money in those, again, if your technology costs are low enough. And actually, banking as a service to me is the bit where we apply the license as well. Obviously, we can only do that in markets where we're regulated. But the advantage there is we get the deposits on our balance sheet and we can utilize those too. We can also do software as a service, so just taking the core banking technology and supplying that to financial institutions in markets where we're not licensed, because we've got this flexible modular system that's scaled.
If I'm not mistaken, is the area you personally focus on, the software as a service side of Starling? Or?
Yeah, it's a kind of a real focus for the business this year, growing that side of it. We've been building out the UK bank and the technology platform for the last 5 years or so everything in the bank's running on the in-house system. And now we're focusing on developing that part of the business, which is Engine, as the platform is known.
What are your thoughts about that?
We're doing
as a service.
Well, we're doing it already. It's not that big and pronounced an integral part of the strategy, but within our ING innovation unit, we have built a couple of assets ourselves within ING Labs, and they're presented here today as well. B70, 70. Stemly, there's Corp ID and Blacksmith, and specifically Corp ID and Blacksmith have originated from customer experience products that we had in the KYC CDD area. And we've built assets ourselves, which we are now not only selling internally, but also to external customers. Because a lot of banks, non-bank FIs are running into similar issues. And we find that the solution that works for us, we can now sell externally as well. Those are small ventures, but those are SaaS ventures as well. Banking as a service, I would think first and foremost of risk methodology. That's obviously one of our core businesses. And we're also experimenting to see whether the risk abilities and capabilities and modules we have, we can work together with large corporates and they use our systems, parts of those, for risk methodology with their clients and suppliers.
Okay, it's interesting. Conceptually seems like a logical step to think about, if I cannot provide a service, let me work with a third party to provide that to me. But financial services are a very difficult space, right? So there's an element of regulation. What happens if you sell a financial product in a banking as a service proposition and they end up doing something wrong? In the contract, obviously it says you are not working with ING, but you're working with this provider that I've given to you. As far as the regulator is concerned, they probably would not like that. And as far as the public opinion is concerned, they would not like that. So how do you get around monitoring and managing the credibility and the reliability of these providers from the regulatory and compliance perspective?
Well, we don't get around it. And we make life for some of our startups actually harder. Because if you compare what some of the fintechs can do because they're without regulation versus the startups within ING, it's challenging, but they need to comply with the highest standards that apply to the bank overall, because in the end, that's where they will be competing. So they are not going as fast as some of the fintechs outside. But we've also seen with some of the fintechs and the larger names that they run into regulatory issues at a certain point in time. So I believe we should move away from regulatory. It's challenging and difficult. Yes, it is. And we didn't like regulation when it was coming, PSD2, but now we also see the opportunities. So
regulation can be boring, you're right.
Oh no, it's sometimes it is boring. But hey, we're here, we're in a regulated environment. And why do we have regulation? To make sure that the customers are protected.
So they understand correctly, if a financial services provider works with you, banking as a service, they have to be more compliant than you are, more extreme than you are.
Yeah.
Yeah, good to hear. If anybody's here thinking about partnering with ING, you know that now. Guys, what do you think, Sam? What are your thoughts about it?
Yeah, we have the same thing. We're a licensed bank in the UK, and so whatever goes through our systems is ultimately going to stick with us and our regulation, and so we have to do the right level of due diligence before we onboard someone from a banking service provider, and we have to monitor the way they're using it and ensure it's behaving as expected, and we will exit people from the platform if that isn't the case. We've got no choice. But I think that's the right thing. There's a lot of scrutiny in the UK in particular at the moment about the numbers of fintechs and the quality of their financial crime controls, and so there'll be a leveling out that will come because the regulators will move on from what the banks are doing to the e-money providers, and they are in the process of authorizing the crypto firms in the UK as well. So the scrutiny is coming and the obligations are coming because the criminals will always look for the weakest link in the chain. And you see that now with where most stolen money exits to.
But ultimately, you both see the responsibility of the delivery of a product that is viable and useful and compliant. It's yours, even if it's provided by a third party.
Yeah, it's our name on the license at the end of the day. It's slightly different, I guess, if we're doing pure software as a service, then it's the license holding entity's responsibility and obligations to their local regulator.
So let's extend that to, there's new products that are coming to the market, complicated, difficult problem products. Cryptocurrencies, or for example, tokens. I'll leave you out of NFTs for the time being. So what are your thoughts about that? Because it is not unlikely that at some point in the very near future, you'll be able to offer these products. What will be the point? What would the trigger that would allow you to feel confident and comfortable to provide a current account in crypto or to enable instant conversion from stable currencies to cryptos, etc.? Jeroen, I'd like to hear you. When are you going?
Oh,
okay, Sam, you go first.
Okay. No, okay. Well,
Jeroen's scared. You go first.
I'm with Anne, so I think Sam has the same view. But
the currency itself is never the problem. We can offer accounts in any number of currencies today if we wish to. It's the movement of money that is the challenge with these things. I think there's potential in decentralized payment schemes. The currencies that exist today aren't effective stores of value because they're just too volatile, but they could well become that. That can sort itself out. It's the consumer protection, I think, that's really missing in the payment systems it is today, and the centralized payment infrastructure that we have. It's not brilliant. It's got many flaws. Yes, I think it can definitely be improved upon. But the consumers get a level of protection. We're all held to a common standard of due diligence, AML and KYC checks and transaction monitoring. And if your money is stolen, and in the UK now, authorized push payments have overtaken card fraud as the single biggest fraud. So most of it is legitimate payments authorized by the account holder. They're tricked into some kind of social engineering or confidence trickster into making a payment they shouldn't, or the wrong destination. If you do that over centralized payment rails, all the members are held to a common standard. We have an obligation with teams sat there 24/7 to trace that money very fast and try and recover as much of it as we can. And there are repayment mechanisms. You can recall payments and recover them. In the DeFi world, there is no standards here. It can hop borders outside of any legal enforcement very fast. And so that's what the decentralized infrastructure needs to work out. It doesn't need to be a central body that's enforcing it, but there needs to be an agreement in the rules and a method of enforcing the rules. And like MasterCard have mastered this by making everyone post capital effectively to cover the losses. But they're a central body doing that.
So what you're saying is that once there will be a framework where there will be a protection of the consumer by some governmental organization or some non-commercial organization to take care of it, then you do that. So once the regulator is saying it's safe to do it, you will do it. So you're waiting for a go-ahead.
Yeah, that's our big concern. The same is true with payments today. The UK regulators, you're very well protected paying by direct debit or by cards. There's established protections there. There's a move from card rails onto faster payment rails through open banking, but the consumer protections aren't anywhere near the same. And so the UK regulators looking at enforcing all participants in faster payments to refund people when money is stolen or when goods don't arrive to the required standards. If they put that imposition on anyone who's offering access to crypto payment networks in the UK, that would fundamentally change the business model of the crypto exchanges because they'll become liable for the activity of their users.
So once the regulator says it's okay, you will be there?
Yeah, I don't think we're necessarily looking for the green light. We're there to protect our customers, and the customers will lose trust in us if they fall victim to them. And the court of public opinion and the court of political opinion, even if the law doesn't require us to do, would effectively necessitate us reimbursing those people. And if we don't make any money on the transactions and we're wearing all the losses for the crime that's taking place there, it just doesn't make any commercial sense. They're not an effective method of payment exchange today anyway. The cost of a UK fast payment or a SEPA payment is like a penny. There's very few crypto exchanges that can settle that.
So Jeroen, if it's complicated for the customer, if it costs too much money, and if it's risky and it's illegal, Starling won't do cryptocurrencies. What are the conditions that?
Sorry, Alessandro, but I'm with Sam. Even if the regulator says that it's allowed, that doesn't automatically mean that we will go in, because it still needs to be something that makes sense and is part of the strategy and the needs of our customers.
Yeah.
For now, crypto has been punting and investing. We look at digital assets and we look at the underlying technology. That's where we believe that there are a lot of opportunities. And across the digital asset space, we look at the developments on CBDC, NFT, stable coins. Not cryptocurrency as much as an exchange mechanism. Yes, you need that in order to get to well, the metaverse eventually to transact. But we are much more interested in the underlying DLT technology to see what the tokenization of assets. That's where we believe we can solve real life problems. Mortgages, tokenize those, for examples.
So that was the question I was going to lead into, because one of the things that exchanges using cryptocurrencies to send money is that it delayers a lot of the processes that are there. So, and using distributed ledger technology, using that whole process and approach is something that could make the banks more efficient and the way we do banking.
Yes, absolutely.
So, but the big challenge there would be that it goes against legacy and how banks are operating in the past. So one of the things that Sam alluded to in a way is that they are not just cheaper on the technology side, they're also cheaper on the process side. Now, how does a big bank like yourselves that's been around for a few years, has created layers and layers of regulation and process, etc., operate or think of itself in a situation where you have players like Starling that don't have any of that? So they're obviously trying to create processes that address the problem with today's technology, not the technology of 30 years ago. How is a big bank like you being able to address getting rid of the legacy issues in a world where many of your competitors don't have them?
Well, there's legacy and legacy. So from an IT perspective, yes. And
that's the easy one.
Well, that's not the easy one. Trust is also a legacy. And despite what happened, I mean, we still have a very high level of trust. So to your earlier comment, and specifically in the digital asset space, I think we have a phenomenal advantage vis-a-vis some of the newer players. And well, BNPL in the UK is becoming a big challenge. Yep. So I think when you regulate that and you move it to players that know how to go about that regulation as well, we actually have an advantage. To your point on the infrastructure, the legacy over there, that is indeed a big challenge. And to my earlier comment, what we found is that to create one bank across 14 retail countries, that turned out to be more difficult than we had envisaged. And now, but the platform that we've built, the technology platform, has shown its results. So, like yourselves, we've been able to build a bank from scratch in 9 months in the Philippines, based on ING technology, what we call TPA, touchpoint architecture, which is modular. It's the same. It's same like Starling, same like Temenos. But obviously, we're still dealing with old legacy of old banks that we once bought in Poland, in Romania, in Turkey, and in Belgium. So that's what we're dealing with and going through as we speak. The other legacy, the trust, specifically in this new space, I believe we have an advantage.
So I wanted to kind of leave with a question actually looking at the future. In the next few years, for a variety of reasons, from the post-COVID era with what's happening in the Ukraine, et cetera, we are seeing a potential contraction in the market. And therefore, we're also seeing an increase in interest rates, which is resulting in less money being available for some of the challenger banks to be able to grow. Now, Starling is unusual in the challenger bank space, and he told me to make sure I would say this. They've been profitable for the in the last year, so that's unusual for a challenger bank, so that's good.
Yeah, last 20 months or so of continuous profitability.
So it's very impressive to have a profitable challenger bank. But going forward, with the evolution of the economy and transformation of what is happening in the conditions in the market, what will happen in your views, and not necessarily to ING or Starling, to the whole fintech space? Will we be seeing a reduction in the number of big players that are operating in that sector that are new, and will we see a resurgence of the incumbents?
Yeah, I think you will see a bit of both. There's going to be a contraction. There's a lot of players that received a lot of money. They're struggling to turn that into revenue, and the money will dry up at some point. And on the other side, I really wouldn't write off the incumbents. They've got trust, they've got the brand, they've got a lot of existing customers, and they've got very deep pockets. You just need to look at JP Morgan setting up their Chase brand in the UK. They're going to lose $450 million on it this year alone, acquiring customers and taking market share, and most fintechs aren't funded to anywhere near a level to compete with that. They think they'll lose $1 billion on it before they make a return. No one's pockets are that deep. Most other organizations are. So yes, the incumbents will fight back to an extent. They've got the legacy of the organization and the culture to change, which is a challenge, and technology is definitely solvable. And there will be a contraction in the market. There's so many similar-looking firms if you walk around the hall here today.
So what do you think, Jeroen?
Well, I believe there's going to be...
Did you win the battle at the end because of COVID
it's not a battle.
and Ukraine?
No,
No?
no, but we're in this together. So I gave the example in Germany of working with fintechs, and we have 119 fintech partnerships across ING, and it works. Because there are certain areas where they go faster, they're nimbler, they're more innovative than we are, and coupled with the deeper pockets, the large balance sheet, 38 million customers, yeah, those are very strong combinations that can be very successful. I hope that there's going to be more sounder questions other than only growth, focusing on profitable growth. We focus on primary customers, and it's not the number, but it is the service we provide and the value we get back. Growth by itself is not a purpose.
Yeah, the customers aren't the answer here. It's
Profitable growth, yes.
So the concept of profitability will become again a metric to evaluate the
Very good to hear that.
the
Very good to hear
success of a bank.
Yeah.
So thank you very much, both of you. It was a great conversation. Thank you very much for being our audience.
Thank you.